You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. The Options Insider Radio Network is sponsored by Fidelity Investments. Fidelity's Option Trade Builder tool can help you confidently build an options trade in 3 simple steps. Just choose a strategy, select a contract, and then review the benefits and risks of the trade. Learn more about Option Trade Builder at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risk. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of the characteristics and risks of standardized options. Fidelity Brokerage Services, LLC, member NYSE SIPC. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. Be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means it is time once again for TWIFO. This Week in Futures Options, a program where the name says it all. We break down the week that was and indeed still is on the futures options side of the fence. So maybe some gold, some crude, some ags, some equities, some whatever, lean hogs, whatever's floating your boat out there this week. Whatever's moving the market, we will talk about it. Of course, we're mixing things up a little bit this week, giving you guys always send us in great questions and comments, giving you guys a little bit of the reins this week to determine what the heck we talk about. You guys are always writing in saying, talk about this, talk about that. So we're going to do it this week. We're going to let you guys choose. So that way we are blameless. And joining me to help me do this listener question, listener appreciation extravaganza, call it what you will, our old friend, Mr. Nick Howard, the founder over there at Bantex Technologies and creator of a little platform we use all the time called Quick Strike. Mr. Nick, welcome back to TWIFO, sir.
Hey, what's happening? This day is flying by, so I can't believe it's 1:30 already. And the fun show, listener questioning show is always the fun show.
Listener questions is indeed always the fun show. So let's get to it. Before we even get to that, really quickly, Mr. Nick, we were talking on some of our other shows about, there was actually, I'd like to get your thoughts on this too, because I don't think I ever had a chance to get you to weigh in on this. Last year, obviously, was a record volume year over there at OCC and for the equity options. Similar, things going on over there on the futures options there with CME. So the big question was obviously, what's 2019 going to look like? And we asked our audience, what do you guys feel? And you think we're going to beat the record numbers from 2019? And close to 80%, 70 some odd percent said yes. So we have a very bullish audience, at least on overall volume. Of course, then the numbers came out for January. OCC was off about 12%, and we're seeing similar 11%, similar levels over there from CME with options volume off about 12% in January from January of 2017. A volume averaging about 4 million contracts a day. But if you break that down a little bit, there are some interesting nuggets within there. There's so many different things trading over there. Things are up and things are down. Let's see what was actually lighting it up over January. eMini, NASDAQ 100 futures and options. Surprise, surprise. ADV grew 51%. To about 500,000 contracts. Dow, same thing, futures and options grows 35% to not quite 250,000 contracts, but pretty close. eMini Russell, our old friend the Russell 2000 futures and options, ADV grew about 30% to 139,000 contracts. Also seeing growth in the S&P sector select, easy for me to say. And the Wednesday weeklies doing pretty well, up 56% to still only 4,000 contracts, but people liking themselves some Wednesday weeklies. Let's look in your neck of the woods here, Nick, to the Treasury side. Overall, Treasury futures and options up 4% in January. So again, there were some bright spots to nearly about 4.5 million contracts. Treasury options ADV up 2% to about 959,000 contracts. The weeklies up a lot in the Treasuries, up 21% to 170,000. That's ADV. Again, let's go to metals. Metals options ADV up 9% to 62,000 contracts. Oh, our old friend, live cattle and lean hogs also lighting it up in January. Live cattle futures and options ADV up 4% to 87,000. Lean hog futures and options, aka hashtag hog love, up 20%. So they were feeling the love to 65,000 contracts. And then even the ruble feeling the love, 120% to 2,800 contracts. Look at some other metals here. Copper, we talked about copper with blue last week. Copper ADV up 152% to 2,400 contracts. So again, it's not the most high volume contract, but there's been a lot going on with China. When there's a lot going on with China, there tends to be a lot going on with copper, and that was the case here. Overall, precious metals options, so that's the entire complex, grew 7%, ADV, 59,000 contracts. If you break it down a little bit, gold obviously doing the lion's share, 51,000 of that coming in gold. That was up 8%. ADV for silver up about 2% to 7,700 contracts. And we talked about this blue last week as well. Palladium up 6% to 5,200 contracts. So palladium getting up there as well. So a lot of things to break down there, Nick. Were there any surprises for you? And then B, I know you get to do it a month later than everybody else, so you get a little bit of pride of place, but does this January volume, does this give you any thoughts on whether you think 2019 will outpace 2018 from a volume year, or does it not change your mind? You still think we're going to beat it or not beat it? I don't know where you come down on that.
Well, it was pretty good last year, so it's going to be tough to beat, I think, given some of the uncertainty, a couple of big commodity swings, China incident, just president's overall rhetoric. So I think that this January lull is probably a little bit welcome, although everybody always likes to have as much going on as possible. But the lull is probably a little bit welcome just in terms of status quo or a little sideways to catch our breath. I would think that unless we have some shocking things occur politically, which is always the possibility, that we might see a little bit less than we see last year. I would like it to be the same or more because it's always good. It keeps it interesting. But somebody I just saw something on Twitter where China and the U.S. are unlikely to talk now until March. So if they keep doing that, and I think the phrase that was used was kicking the can down the road. If they keep sort of kicking the can down the road, so there's no real result in anything, or they keep pushing the investigation on, and there's no new things that come out there, or no new indictments, or no high-level indictments, that maybe we'll sort of sideways trend here for a little bit. So I would say that we're probably the same or lower. I mean, yeah, I got the hindsight of the month being a little bit less, but probably see some increases in some of the asset classes like metals potentially. If things get a bit uncertain, maybe the stock market, equity market may not see as much if we don't have any kind of closure on some of these things that are affecting their overall macro perspective. So I guess we'll see. How's that for a non-answer?
You certainly sound like a first man. You've been hanging out with politicians too long, sir. With your non-answer answers out there. But you're right. And I felt like kind of a bit of the negative Nelly, when I came out and said I didn't think it was going to happen, because last year was one of those crazy years. We had two very tumultuous volatility events, at least in the broad equity space, that drove a lot of volume out there, and similar developments over there in the futures option side of the fence. So you're going to need. I mean, how often are we going to have, a trade war with a major trading partner on top of a government shutdown, on top of all the other things that were going on that were really kind of one-off things that all came together for, I won't use the cliche of the perfect storm, but something analogous to it to really create this volume explosion. I don't know if the market can handle having more of that again this time next year. So I kind of came down on the no side. I would like to be wrong. I would certainly love to be wrong. I'd love to see a lot of volume. Of course, sometimes a lot of volume could also come with some shocks to the system. Maybe the market needs a little bit of a break from that. So maybe people are happy to have a little bit less volume. But so far, at least, January, unfortunately, holding my prediction to be true. But what is fortunate? You guys. We're fortunate to have you guys. So let's get to what you guys have on the brand, a little bit of your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, let's get to it. Time for a little bit of your feedback. We got a ton here, Frank, so let's just go. Frank's the questioner. Nick, Frank is the question. Let's get to Frank's question. Or I should say Frank's. Maybe it's plural. Maybe there's multiple Franks. Frank's wants to know, or maybe it's just Frank S.
Or Frank S.
Let's go with Frank S. I like Franks. I like the fact that multiple people are writing into us with the same question. Frank's. He said, are they Frank S? I like Franks. We're gonna go with Franks. What's the best entry? We're off to a rousing starter. What's the best entry futures option for newbies? I'm thinking something in the equities because most people are coming from stocks. I'd guess stuff like seasonal crop cycles would blow their minds. Yeah, I tend to agree with that analysis on a 10,000-foot perspective. A lot of people coming in, we see it all the time just on the trajectory of this show. Maybe they're coming from other shows on our network and they're starting to look a little bit farther afield for new products to trade. A lot of them are coming from their proverbial, S&P 500, Apple, Facebook option world, and they want to start cutting their teeth in this world. So from that perspective, yeah, I think for a lot of people, the easiest entry point is going to be something in the equity space because the skew is going to be similar. The volatility is going to be something they could wrap their heads around. And so that's easier because you're right. You take them, you throw them into an ag, you throw them into a lean hogs. It's a completely different beast. The skew is different. The term structure is, all these things are different. And they're just not used to that. So I think I tend to agree with that. Something maybe like a nice deep liquid like the eMini S&P 500, something like that where they can come in, really sink their teeth in and get a lot going in there. I think that's a great starting point. Maybe Mr. Nick, do you agree? You disagree? What do you think about the Franks here? Question.
No, I think that makes total sense. Mostly because, as he mentioned, or maybe it's Fran from Kansas, right? It could be Fran
there
from
we
Kansas.
Go. So many ways it could go.
So many ways. I think that makes a lot of sense, only because it appears that we have a lot of the inputs for the equities market in general, meaning we know where to watch, we know where to look, we know what news there is, we kind of know what's going to affect things, earnings, that kind of stuff. But when you start to talk about the ags, like it's rainy in Chicago today, right? That weather system could affect those ag markets in ways that the newbie, or fact of the matter, most people don't understand, right? Same thing. I was asking somebody the other day, as an example, we get these rig counts in the crude, and I asked the veteran crude trader, I go, does that really make a difference? And he's like, no, it doesn't really make a difference. Same thing with the output, right? There's 1 million barrels. Is it really tipping us one way or another from a directional standpoint? But then there's all kinds of these underlying political tensions and people's personal or countries' personal agendas with output, that type of thing. So too many unknowns, right? It's and known unknowns. Who said that? Was some politician that said known unknowns? Who was that? That was one of
Rumsfeld.
Who was that?
Rumsfeld, the unknown
Rumsfeld
unknowns,
said,
right?
No, right. I think I just saw Vice, right? I think that's what it was. The known unknowns. There's too many known unknowns in those markets where I think the equities, at least people are under the perception that they understand it better. It may not necessarily be the case, but I think that's a good start. And with that said, you know what? The futures options may not be for everybody. I think the ES is a good place to start, though.
Well said. Hope that answers your question. All of you Franks. Or maybe Fran from Kansas. I like
Fran from Kansas better.
Okay, Fran from Kansas.
Because it could be a him or a her.
Let's go with Fran from Kansas.
I'm all about inclusion.
You are quite the inclusive fellow. Let's see who else we can include here. We're going to have to include a lot of crude, looks like, Mr. Nick. People got crude on the brain. Let's start off Bear. Bear 12 wants to know what we think about this analysis. He says, I don't think crude vol can sustain for long at these levels. And he includes Eric Norland's analysis recently over there from CME entitled Oil Are Options Signaling Long-Term Uncertainty. This is their off the charts podcast. Eric and Blue are trying to eat into our territory, Nick. They're doing their own little show of over there on CME talking about their analysis. But I touched on this with Blue last week. I actually asked him about Eric's research. Eric likes to look at the implied vol out there in these products, and he's of the mindset that this, like the title says, the long-term options are the options are signaling a bit of long-term uncertainty coming into showtime. Let's look at the old quick strike to see. By the way, you guys can play along, cmegroup.com/TWIFO, TWIFO. That's where you can pull up the latest reports for energy. Select energy from that drop down, then choose WTI, and you'll be off to the races. Right now, net vol over there, just in terms of the WTI VIX, is 3365, aka OIB. So it's up a little bit, but not quite anywhere near where it has been, over the past, 6 months or so, where we saw it, or not even 6 months, a few months, back in December and January when it was trading in the high or listing in the high 50s into 60 actually. So about half what it was. And let's see right now, coming into this week, we're seeing crude, of course, selling off a bit. 52.5 right now coming into showtime, off about 3 handles on the week. And let's look at the vol. The vol actually up, which you probably would expect a little bit, given the fact that we're seeing some tumult out there. Vol pretty strong across the board out there, so getting a little bit of juice out here. Nick, we talked about this for a while. The crude vol, kind of like with gold vol. The question is, can it maintain that that level of bid for a while? Is this a long-term thing or a nearer-term thing? Eric seems to be implying that it is indeed a longer-term thing. Of course, crude it managed to hold that bid for a little bit. I mean, it stayed in the 50s for, at least a couple of weeks. It touched to 60, didn't stay with that. Then it got back into the 50s again for a week or change, couple of weeks actually, late December to early January. Then it kind of has come off about half again. So the story with crude vol has always been what's going to sustain it. Are you feeling what Eric's putting down here, Nick, that this is signaling perhaps some long-term uncertainty in the crude land?
Well, first of all, you know how much I love listening to Eric talk, so I would be hard-pressed to ever disagree with him. But if I just looking at the charts themselves, we were I'm looking at both the 30-day constant maturity and the 60-day constant maturity, right? Because that gives us more of a standardized contract term to compare historically. So, we're a little higher than we were. We were kind of trending in between 25 and 35 for the better part of 2 years in the 60-day and in the 30-day with a similar, I'll put this range on here for the 30-day and see what our vol range was. Yeah, and our 30-day was a little lower than that, probably, we had some lows in below 20s. So we had a real long-term trend kind of sideways with some blips here and there. We had the jumps up in November and come off again, a little bit of jump back up here in the just prior to the beginning of 2019, and now we've been trailing off for the rest of the month here. So I would say that from what I've seen, when those big high levels of vol are sticking around, people are selling those levels. At least some of the traders that I'm talking to, because unless there is sustained movement one direction or another, if we're chopping around in the future, I don't think the vol is going to stay high. If we see these kind of trendy moves like we saw from October to through the better part of December, that's where we're going to see the vol increases. So I would say, just based on the long-term charts, maybe we'll see levels that are a little bit higher than what we've seen on average for 2018 and 2017, but I don't think we're going to see levels in the high 50s and 60s, because I think the traders are looking for opportunities there to sell, especially sell when we're talking about when our quick skew or skew gets out of whack, where something's really bid and the other one's really offered. So people are always looking for vol sale opportunities. Very, very rarely I like to talk about buy and vol, but very rarely are people looking to buy. When you get a sustained long-term, real low trend like we saw in gold and for a while in the equities, people are generally staying away from it. Trend's too long in one way, nobody wants to own it. It's like a Roach Motel, right? You can't get in and you can't get out. But I think we'll see maybe a little higher kind of base level, and but I don't think we'll see too high, in the high 40s or 50s. And I was going to say, we were talking about WTI all the time. Didn't we have didn't Billy Joel write a song, "We're in a crude oil state of mind"? I think that should be our new motto for when we...
I think that was exactly the song that he wrote. He was all about the crude oil.
I'm in a crude oil state of... That's what it is, right? Because I can never remember words to songs, and I'm always making stuff up.
That is exactly what the song is.
Rocket Man, I don't know what the
lyrics about WTI, skew was really surprisingly in-depth for that period of Billy Joel and that early options period. He was ahead of his game. He was ahead of his game.
He had a lot of oil in his hair at that time, so maybe that was the reason. He was slicking his hair back quite a bit. So anyway,
that could be it. I hope you didn't get enough WTI, because we got more here. JS Wager, maybe Jay Swager, asking here: are we stuck range bound in WTI for the next few months between 48 and 55? Any signs in the vol might be heading for a move beyond in either direction? We always talk about the overall vol in WTI. Let's look at the skew. That seems that's kind of like what he's asking. This week, the big contract out here was only a 7-day to go contract. That was 42% of the volume going. Let's go a little bit farther out to get a little bit more meat on the bones here. Let's go out about 36 days here. There we go. That's the contract. That one's got about 21% of the volume. So they got some paper out here, and let's see what was lighting it up out here, how the skew changed. So the puts are bid And that's kind of the case mostly across the board out here. It's just a question of how rich you go out here in some of these weeklies and things. The puts get pretty bid, but they got very bid this week. But this week, yeah, we're seeing the puts got a little bit more rich here in this about, a little bit more than 1 month contract, about 6.3% to the at the money versus 5.9% a week ago. So slightly more bid. The calls got slightly more offered. They went from actually a little more than slightly. They went from 4.6% cheap to 5.3% at the money. So these things are telling us that in the near term, at least, the bid is to the puts and predominantly, and not a lot of love here for the calls, even though the big trade out here was the 58 calls going up 5,500 times. So maybe a little bit of harvesting the old risk premium out there. Went up about 2,700 times on Tuesday, 1,300 times on Wednesday. So question, are we seeing things that are pointing to range? But I think that's a fairly, I don't know, maybe 55. We just broke through that, so maybe a little bit wider. Maybe we need to go the old, what was it, City? What was it, 35 to 78?
40 to 70.
35 to 78 is my range in which crude is being priced in. Do you agree with that range, Nick? Is that too tight for you?
Well, it's I think it's easy to think that that's the range based on, maybe the last month in change. But when we look beyond that, we were trading all the way up in the 70s not too long ago. Again, something we haven't talked about too much lately. You can always go and look at the open interest for the first few contracts and see. So the high put open interest is in the 50 strike, and the high in the call is to 60. So maybe we widen that up a little bit, 48 to 55, make it 50 or 40, 45. So let me see. I don't think there. Let's see what we got. If I go a little bit wider, see what that looks like. If that's got some bigger support, but I don't think it has as much support as the 50. So 45's got a fair amount as well. But I would say, he's probably 55, like you said, we broke through it. 60 is the next kind of barrier. There's some support or some resistance at 57, 58. But, we were also coming off some really high highs. So it's going to take something to push us back where that was. So I think we are probably, that's why the sustained volatility levels, plus those guys do those podcasts a little later, and they take time to get them out there. So maybe levels were a little bit higher, but I think we, OI wise, we're kind of rangy between 50 and 60. I think we would be, I think it would take a lot to get pushed below 50 too far, but the 60, it might be a little bit of ways off. But we'll see, right? I mean, and you mentioned the skew. Let's take a look. I mean, the vols are, for where the vols are from an at the money standpoint, I mean, we're not seeing anything too crazy here from a long-term perspective. So puts could get more expensive and the calls could get cheaper. I would expect that to happen first before we see it the other way around. And then, Mark, before we move on to anything, before we want to make sure I have one other new thing to cover on the TWIFO that I want to talk about. That we've been mentioned sort of in words, but now you can actually see it in numbers when we get a chance. So just let me know when we're going to do that, or if you want me to.
Now I'm intrigued. I have to hear what this thing is. So what are you talking about, sir?
Should we talk about it now? Okay, good. So if you go look on the report, and we're going to talk more about what's going to become available in terms of the report by the end of the show. But we have we restructured a little bit. We moved the future over to be part of something, but we added something to the volatility section, and we're calling it shift and slide. Okay, so what's interesting there is, we remember, Mark, we talked about how the at the money vol changed because we changed strikes, right? And we said, did we move along the vol curve, or did we actually have an up or down move in volatility? So now what the shift and slide tries to do for you now, it's telling you how much. So the shift part of it is how much the old at the money strike changed, and the slide is how much we moved along the vol curve. So when you look at it, we see, for instance, if we look at the April contract in here while we're talking about it, we have the at the money volatility is up like 0.4 vol percent, but the curve actually shifted down by almost a full vol, but we slid up the volatility from a higher strike to a lower strike, meaning we went from a callish strike to a put strike, and we have skew. We've been talking about how there's put skew. So a lot of the vol increase came from a move along the vol curve where, in reality, we had a shift down in the vol curve more or less, right? So we gained volatility by changing strike, but we lost volatility with actual shift in the vol curve. And if you click on that number, Mark, that it's right now, it says for me negative 0.94, you see that we had movement along the curve, but we actually saw a move down in the overall vol structure over the last week. So I think that's going to be a really interesting way. So we're calling it the shift and slide. It's sort of like, a little dance, little line dance that we can do, the TWIFO line dance, the shift and slide.
I like that. I did notice that column. I was going to ask you about it because, the vol section, you can find it for yourselves, listeners. If you're playing along with the big boy version of Quick Strike there, you'll see it in the volatility section. There's first, of course, the strike, and then there's at the money, and then next to it is what he's terming the shift and slide. So just so I have it correctly, the shift is the top number, and then the slide is so the shift is how much, the strike change, and then the slide, the actual changing along the curve, the skew, is the bottom number. That's correct?
Yeah, so right. So basically you see the at the money is going to show the change in at the money volatility, right? Because we always tracking whatever the at the money is, regardless of what strike it is. But what the shift and slide is trying to do is, and when you click on that number, you can see the curve, if you're in the subscription versions. So it's really trying to tell you, is vol really off or up, or or did we just move along a volatility curve, right? So you'll see what I think it'll be more prominent when we don't change strike and we see a decline or an increase in vol. You'll be able to see that it'll be all shift and no slide. So you'll get the hang of it as you start to analyze some of those numbers and take a look at the curves. But I think it's going to be, for me, it's always been, is vol really up or is vol in, or how much is based on the movement along the curve and how much is actually a bid or an offer in the volatility. So I think it's going to be, I think it'll be a telling number for us. And I think, and if you go over and take a look at it on the equity side, I think it's going to be even more visible, where you get a lot more slide than you do shift. And you'll see that in the numbers more than anything else. So, or you'll be able to tell
really shift as much in equity land. You're right.
Yeah, So anyway, it's something to watch and learn, and it'll take a little bit to get used to. But I think once you see it, you go, okay. When I see the shift and the change in at the money being close to each other, then I know that there's a real vol bid or a real vol offer.
That's pretty cool. You should put out a little a tweet about that, or like a link to here's what it is, here's how it works. We could tweet that out and share maybe an in-depth video featuring you breaking it all down. What do you think?
I could do that. I'm actually going to be I'm in the process of making a handful of videos to go out to some of our subscribers. So those will be available on YouTube coming up in the next week. So.
So you haven't had your fill of listening to Nick, and you want to see him. There you go. Now you too can see him. And this is cool stuff. So if you're not playing around, like I said it before many times on the show, if you're not playing around with the big boy version of Quick Strike yet, what are you doing? First off, don't stop listening, because we want you to keep listening. But then head on over to bandtix.com or quickstrike.net. Get the big boy version so you can see all this cool stuff, like the shift in and the slide. And we got so much crude. I might have to cut it off on crude. Let's see. We'll do one more. You want to do? Let's do.
I don't know what that question says. If you're pointing to market maker T67, I don't really.
This guy, he wants to know what he wants to know what we think about this technical analysis. And the article he sent us is from it's from FX Street. It's people doing technicals on WTI, saying that it has dropped below 52.26 to a low of 52.26, which is a little bit off of right now, 52.68. He says 51.41 is the 27th fractal low target. So you know me, I've talked about this before, Nick. I'm not the biggest guy on the technical. He says it's broken the 21-day moving average here, 27th fractal low, RSI and MACD, all negative, and volume is with the moves. He says it's just a technical sell-off. That could possibly be. We're not seeing a huge driver for this in terms of the downside. Obviously, the notion that you think the exacerbated trade war would actually be maybe a little bit of a bullish sign, but we didn't see that playing out there today. Because I guess the crude market not really following what the equity market is up to. I mean, sell-off they are, but not in terms of the concern about global demands. Everyone thought maybe that was behind us with the trade war talks. Not today, maybe not so much. So you think that would maybe give a little bit of lift, but apparently not. Then, of course, looking out here to some of these other things, talking about the European Commission. So some of the fundamentals I could probably agree with. But yeah, I've never been a guy to, I don't know, Nick, are you big on, 27th fractal lows and moving averages and RSI and all that stuff?
I don't know. Sometimes I believe some of that is a kind of a self-fulfilling prophecy in that if enough people watch it, then people are trading it and it kind of perpetuates itself. But I think, the technicals may, I would use it as maybe a supporting to some decisions, but I wouldn't make it I'm not a futures trader, so I wouldn't make it as my sole decision-making thing. But I believe that if that stuff applies, it's more in a trending sort of non-news market, because then, there's been a pattern that's established. But when you come around the big OPEC meeting or the EIA, that kind of stuff those guys aren't looking at it. They're looking at what are they going to produce and what level do we want to have in oil in order for us to be profitable or for us to be able to sustain business, So I don't know. It kind of scares me. 27th fractal, because what's happening to the first 26 fractals?
Exactly. I really only pay up to about the 25th fractal. Beyond
right.
that, I don't really care much anymore. It's not my area. By the way, I think I said that obviously that was bullish for crude. That's obviously bearish. So all this weakening of global demand and the global trade talks. Also some stuff going on with the oil fields in Sahara and stuff. So a lot of things going on out there that are global that can tend to maybe weigh on crude a little bit. I think we're seeing a lot more of that than we are seeing this 27th fractal. But hey, to each their own. I don't mind the technical guys because they provide paper flow for everybody else out there. So if you're buying what they're selling, then more power to you. All right. Here we go. We can talk about some reviews. I mean, we don't go out there. We don't solicit. We don't look for reviews. But if you feel so inclined, we'll take them. They're kind of fun, and it's kind of fun to see what you guys think. Here's a 5-star review. I don't know. This might be from iTunes or from Google Podcast. I'm not sure where this one was pulled from. Comes from Jake Luttrell. He wants to say, "Great content. Thank you." And we right back at you. You're welcome, Jake. If you like what you hear on this or any show on the network, head on over to your platform of choice. If you feel so inclined, leave a review there. Could be 5 stars. Maybe you're not a big fan of Nick. Maybe you want to bump it down to 4. I understand. I feel where you're coming from. But in general, if you have a question, though, don't ask it on those platforms because they tend to be, shall we say, much slower in terms of getting everything to us. We have a lot more timely ways for you guys to get in touch with us. If you do indeed have a question like Bob here, Bob Engles wants to know, do all the synthetics that hold for equity options like long stock, short call, etc., equals short put, also hold for futures options? So of course he brings off the long held one that effectively the covered call, your long stock, you short the call, that's equivalent to being short a put. Does all that hold for futures options? Yeah, I mean, pretty much. The put call parity is a put call parity thing. The underlying is a little bit different, so some nuances there that are a little bit different. People are probably more used to, on the equity side, having the perpetual underlying. They don't have to worry about the expiration date. The expiration date of the underlying in the futures always gets people a little bit more concerned, shall we say, from an entry point. Going back to that question we had earlier about the best entry point for futures options. But yeah, the synthetics are going to be synthetics, outside of some very aberrant scenarios where there's some crazy event risk pricing. And other than that, there's not a lot you can really do to change a lot of that. Mr. Nick, do you have anything for Bob who wants to know, do synthetics that hold in most options, does it hold in like a WTI, Nick?
Oh yeah. I mean, I do it every day, right? I mean, when I'm looking at the pricing sheets, you're paying attention to that, especially if you've traded before it. You think in synthetics, right? I mean, I was actually explaining it to the guys here yesterday, just about different ways for calculating at the money straddles and utilizing, either the call or the put to get a real / synthetic price, especially around the at the money. So they all hold. There's a lot of good stuff that people can do with straddles and butterflies and ironflies, and that's how a lot of people price stuff, is looking at that and to see if those are in line. So absolutely, and it pays to know your synthetics. That's for sure.
Well said, sir. Let's go on to this one here. Alcore, he wants to go to the equities. So we'll go to the equities if you want to go to the equities. Alcore. Not quite Al Gore, Nick, but Alcore.
I was thinking albacore. I was thinking he was
albacore tuna. Could
big
be.
Tuna.
Man likes himself a little bit of tuna. We don't judge here. Whatever floats your boat. He goes out. How far? You like that? See, you like puns. I know Nick can go for a pun or two. How far out can I go in the eMini S&P? I like how you spelled that. I spelled it all out. S&P or RUT options. Does it make sense to do collars out to the max expiration, or maybe just a couple of years? Well, let's pull it up and see, Mr. Nick. How far out can we go? He wants to go in the eMini S&P. How far out can we go? eMini S&P.
You can. Well, a couple things Well, this is interesting. Can I go?
Yeah,
with this
go
one?
ahead, chime in. Go ahead.
So first off, if you go out to the CME Group cmegroup.com/quickstrike, no C in quick, there is a product expiration browser, and there you can just open that up and type in ES, and you'll get everything related to the ES future, all the options, and you will see all of the available expirations. So I can tell you right now the longest dated one is in the kind of the regular quarterlies, which is December of this year. And then you have weeklies that go out to middle of May, and then Monday weeklies that are only this month, and Monday weeklies, Wednesdays that are this month. And then you have end of month contracts as well, which go all the way out to July right now. So you have a little less than a year. When you're going out there, I don't know, Mark. I don't know a lot of. I'm going to double check something for the listeners here and give you an idea.
Yeah, while you check, I'll look into this. But yeah, you're right. And he also asks about the Russell 2000. That looks like it goes out to September. Is the longest term they have listed right now. So not quite as far. Yeah, the eMini in general is a more retail-friendly contract. They don't really list them out, 5 years and all the craziness that you can get a couple years out with some of the, if you go to the big ES, options, obviously you can go maybe a little bit farther out. But in general, I take a bit of a dim view. I'd be curious to get your thoughts on that as well, Nick. I take a bit of a dim view on very long-term cars. In this case, the eMini going out to December, I could see a case for that. About a year, that's not that long compared to other things I've seen. Again, we talked about collars on this show, I think, with some great studies coming out of the OIC group there, and what the most effective dates is. And they found a lot of their data, and they applied it not just to equities, but to all different underlyings, precious metals, energies, ags, etc. And it seems like somewhere around the 6-month time frame on the put, and then getting nearer duration on the call. Obviously, if you're doing a collar, you don't want to be a long-term collar where you buy the put and the call all the year out and set it and forget it. You can do that if you want to be that set it and forget it guy, but you're not maximizing the collar at all. If you're going to buy that put a year out, you got to do some work to pay for it. So you have to move that covered call portion at least into the monthlies. In the weeklies, if you're fairly aggressive, but at least into the monthlies. Get out into the monthlies. You roll it once a month. I know. Bit of a pain. You got to do it 12 times as opposed to 1. But if you do it that way, hopefully your income portion will be better. You'll be more dynamic with it, so you can change your levels every month. Right? If you sell a call now, what's it going to be like 6 months from now, that level? You could be all the way through it, and you have to roll. So having it dynamically done every month kind of builds in that roll factor for you. So if you don't want your underlying to be called away, you want to give yourself a little bit of room to the upside, you can keep rolling it up every month, or just keep writing a new call higher every month, not even have to roll. And that way it gives you a little bit more flexibility in there. And also overall, it'll help pay for that long-term put that you're paying a lot for. Remember, these things are not cheap going out all the way a year. Go figure. Everyone in the S&P wants to buy puts, right? And they want to sell calls. So they're all trying to do what you're looking to do. So you have to find ways to up the ante in your favor. And that's just going out, setting it, forgetting it, buying it for a year and being done. I never liked that approach. I like to be a little bit more active and be a little bit more, and it will reward you at the end of the day. It will work out better over time doing it that way. Mr. Nick, do you have any thoughts on long-term collars in the equity? Could be Russell 2000, could be S&P. Take your pick in general, and then B, anything else on the expirations here?
Yeah, I mean, first off, I'm just looking again. If you look at the markets like the S&P, and then everything outside of maybe the Eurodollars, okay, you're going to see most of the activity take place in the early contract or the front quarterly contract, and that's no different in the eMini. So the majority of the open interest in the options, almost 1.2 million of the options expiration OI is in the March contract. And you go look out in the D's contract, there's maybe 100,000. So two things are going to happen if you go out to the collars way out there. You're going to have to cross a much wider bid-ask spread because there's barely any markets being made out there in all likelihood. You don't have a good read on what the underlying is. Today's volume in the D's contract was 0, with a total open interest of 353 and 23 OI change yesterday. So that means probably 23 to 50 contracts traded. Okay, so that's kind of more long-term positioning type of thing. And I just think that, like Mark said, you're better off probably being more active with roll, because you're going to get better price discovery, more liquidity in case something happens, so you can cover. And you have a much more active hedgeable underlying when you go to this active quarterly in March, because you're not even seeing, you have an OI in the June contract, which is only 134 days to expiration, that is 1/4 the amount of the open interest in the March futures contract. So I just think that you get yourself into some trouble, especially if you're not a veteran, trading illiquid, long-dated eMini options. Those three things in a row kind of scare me when it comes to trading options.
Yeah, you're right. People don't factor in the actual, obviously, cost of execution as well, and that could be significant out there in those products, which are less liquid. You're going to have to pay a lot more to get something transacted out there. So that also factors in the efficacy of your strategy. So all those things in mind, Alcore, doesn't sound like Nick is as well a fan of going out to your max expiration to do the collars. I think somewhere in, let's say, 4 to 6 month range on the put and somewhere around a month for the call. I think that's a better setup. And your mileage may vary depending on where you like to be, how much you want to adjust, that sort of thing. But in general, I think somewhere, as a rule of thumb, somewhere in that time frame seems to make the most sense. Oh, more Google love. This comes from Jake. He says, 5 stars on Google. Thank you, Jake. He says, thanks for your continued effort to educate the retail investor about options trading. Well, you are welcome. Thanks for listening. Thanks for reviewing. All the good stuff you guys do out there. The Poet. They have a literary fellow writing in. The Poet. He wants to know, what does it mean when an options, plural, I think he meant a singular. What does it mean when an option, see, the Poet making all these grammatical mistakes, Mr. Nick. I'm embarrassed for him. I'm just giving you a hard time. What does it mean when an options is delta skew? Delta skew. We talk about skew a lot here on the show. Obviously, it's kind of a core component of what we talk about here on TWIFO. But we usually talk about it from the volatility perspective. Which area? We just talked about it with WTI a little bit ago. The puts were X% cheap to the at the money, or in that case, rich to the at the money. The calls were X% cheap to the at the money. That's kind of how I tend to view skew. I don't really talk about skew in delta terms. Is this something you look at, Nick? The delta skew of a product? Is this a term you throw around?
Well, I mean, when we talk about, that's a hard one to know exactly what they're asking, because I don't know that I have heard delta skewed, but when we talk about the quick skew or the risk reversal, we are talking about a particular delta on the curve and what the skew relationship is. So if I'm going to interpret the question, I'll say, when people are looking at risk reversals, we're going to look at the 25 delta risk reversal. So that is a delta skew. So it's telling us that something that's 25% out of the money on each side of the at the money, what is the relationship between those two theoretical locations in strike? So when you're doing that, you're doing what Mark talked about earlier when he was talking about quick skew, and what we talk about on a regular basis here, risk reversal and quick skew, is where is the bias, on the downside or the upside? So what does it mean when options are delta skewed? It means it's either telling us that there's there's indifference if the value happens to be the same in those 25 delta. Indifference is to the direction the market's going to take. If it's weighted towards the put side, it means that the majority of people are betting that the possibility is down because that strike or that location in the vol curve has a greater volatility, which means the price is higher, which means that there's more activity, more demand. Or it's offered, which means that people are selling more there, that it's available at a cheaper price, so the likelihood of going there, or if we go there, it's less fashionable, which means the market's going to go down. So it's just a way of sort of, if I'm interpreting it the right way, or at least the way I interpret it is kind of giving us an idea of directional bias, if there is any at all.
Yeah, that certainly could be the case. That's kind of the standard, skew definition, right? 25 delta put, 25 delta call, 50 delta risk reversal. That's kind of where it all comes from. So that could certainly be that's how I look at it. This is not a term I've really bandied about. This has the flavor to me of a term some guru threw out there, and that's probably
for $50 a month.
That's right? Probably where he heard this. Skewed. I'd be curious, the Poet, where you heard this term delta skewed, and maybe a little bit of the context, and we could break it down for you. But in general, what Nick said is pretty much correct. That's how we look at skew: 25 delta put, 25 delta call, 50 delta risk reversal, and that's kind of where, if there's a bias coming in there, that's where it comes along those lines. But that delta never really changing. It's the 25 delta on each, so that's not, the delta component isn't really what's significant there. So that's why I find that question a little bit strange. Since we're talking skew, Mr. Nick, this one, Kaichi, asking, you said all vertical trades were skew, but what about calendars and diagonals? Isn't that skew? Yes, several other people have asked a similar question. This is a couple of weeks ago. I think a listener had a question. How do you define a skew trade? So we broke it down in very simple terms. Like Nick just said, the 25 delta put and the 25 delta call in that particular month is the traditional definition of skew. So any trades that trade that in that vertical same month expiration are considered to be skew trades. So a very wide call vertical, a put vertical, an iron fly that goes really wide, all these kind of things. Butterflies, anything that goes up and down the strike, a lot of strikes, has a lot of distance in between where you're actually being impacted by the changing in the skew, the changing in the volatility levels on different strikes. Those are skew trades. I also mentioned, I think when I answered that, I wanted to kind of keep it simple. I didn't want to get into crazy things across the term structure. But yes, technically you are correct there, Kaichi, and everyone else who asked about this, that yes, there also is skew that can go out across the term structure in the different months. And then there's that. Then you're getting into other definitions of skew. People will look at that chart of let's say the at the money implied across the different months. That's your term structure chart. They will look at that and they will term that as skew. And that certainly can be viewed that way as well. So you can get into that, and then that gets into a whole other level of skew. But you're correct. Yes, technically that can be skew, and that could all come into play. I kind of wanted to just keep it simple for our listener, whose name I forget right now, who asked that question. But yes, all of you guys who asked about what about time skew, and yes, that all counts. That all is skew. I was just trying to keep it simple. See, Nick, they won't let me keep things simple. They want to get things crazy advanced, which I guess is a good thing, right? We like that they want more from everything.
Yeah, I mean, and skew for me is, I tend to, skew is a relationship between two volatility levels, right? But really, typically, you're looking within, like you said, within the same expiration. So I would tend not to look at calendars and diagonals so much. You could, depending on what strikes you choose and that kind of thing, you could be doing a play on the skew that's taking place within the expiration. So it's always going to come back to the relationship within the individual expirations. And then, the calendars, then you're starting to look at term structure. And I don't think people necessarily talk about term structure in skew terms so much. They don't necessarily, it's just sort of like, I wouldn't use, that's not the word I would use. I don't know what word I would use. I would just use calendar diagonal.
Yeah, I tend to refer to it as term structure too, but I have heard people kind of refer to it as skew, and you could quibble with it.
You know what they mean, right?
Yeah, you know what they mean.
You wouldn't use it yourself.
Exactly.
Right?
So I don't want to say Kaichi is incorrect because they're not. It's just a different usage. But yeah, interesting comments. A lot of people had similar thoughts. So you're not alone there, Kaichi, Mr. or Mitch, Mrs. here. Here's another, more love, 5-star review from Steve A. Best series of shows about trading options on the net. I think he's referring to our network, in which case, thank you, Stephen A. That might be from iTunes, I don't know. We love the love. Right back at you. Keep listening, keep downloading all the shows, including Twifo, and getting all the love. Look at this, Nick. We're cranking. The show's almost over. Didn't reply. See, time flies, doesn't it, when we're answering all the listener questions? It's kind of fun. You kind of just get in the zone. All right, let's see. Mr. Nick, I'll let you choose. I think we got time for one, maybe two more. We'll see how long we take on to answer the question. We got a question here from Opt Addict about delta neutral, or do you want to go back to the land of WTI, in which case we can have Brent WTI spreads or options on WTI versus the USO? Which of those three floats your boat?
Well, let's definitely do the Opt Addict. So you see, one thing real quick. Sean mentioned the other day where he looks at license plates and always trying to decipher them, and I do that all the time, right? So, and I got it from my dad, who used to look at every word and spell it backwards and say it backwards. So it got to the point where we'd say, Dad, just stop already. Stop spelling everything back. Because Harry Carey used to do the same thing as well, I believe. But Opt Addict. So I'm always looking for different ways to interpret that.
Yeah. You and Sean do like your different flavors of the names. You could spend some time on that, the two of you.
Yeah,
I have noticed.
But let's do that one because I think that's a good one. So
let's do that one first. Yeah, all right here. Opt Addict wants to know, I see a lot of talk about delta neutral trading when using equity options, but not so much with futures options. Why is that? Is it just not a popular strategy, or is there a fundamental difference on the futures side that makes it less viable to dynamically delta hedge a position? All right, a lot to unpack here. Delta neutral, of course, listeners, a strategy where you have some long or short deltas, doesn't matter. You have the directional position, you have a delta position to an option. Let's say, you buy some calls in XYZ. Now you're long a bunch of deltas. Maybe you don't want those. Maybe you want to focus on the pure volatility on that strike and not worry as much about the directional component. So you would sell underlying against those, or you could sell other options as well. You're just going to sell something that has a delta component to effectively bring your delta as close to zero as you can. And over time, you're going to dynamically hedge it, as you mentioned. So if you go up and your delta increases, you get long more deltas, you're going to sell it off at a certain point. And then if it drops, you're going to buy them back, and vice versa. That's called gamma scalping. And so that's a technique that's tried and true in the market maker world. That's kind of how a lot of them tend to pay for things on otherwise quiet days. They tend to scalp their gamma, and there's an art to that in and of itself. And a lot of people have spent a lot of time devoting technicals, and others, our friends over there at ORAT certainly did a lot of that in terms of gamma scalp levels and where the best place is to look at that stuff. But yeah, you're right. We don't hear that bandied about as often. The answer to why is that, first off, I don't really know why we don't talk about it as much. Maybe it's just it gets more play for whatever reason in the equity world. I mean, I think trading pure vol look at the vol space, for example, right? There's a huge vol complex on equity vol. There's VIX and all the things that have sprung up around it. So trading S&P and broad index vol, there's a huge base for that. And so as a result, I think the vol trading in general, and the people who are going to do that, they want to do things like delta neutral and hedging, dynamically hedging straddles and things. I think there's just more of a market for that in the equity space. I mean, we do see some things floating around the things like energy and stuff. Like, for example, there is a crude VIX. There's a VIX of WTI. I didn't mention it today, OIV. But there's no real tradable products around it. So you can't really go out there, and there's not a huge demand for dynamically delta hedging the volatility in OIV. So there are in crude. You certainly can do it. It is done. But it seems like for whatever reason, the volatility market has really aggregated around index volatility. So that's probably point number one. But yeah, fundamentally, you could still do the same things. You could still do your gamma scalping, like I mentioned before. You get long deltas to the upside, sell them out, buy them back when you get low. That underlying strategy still works. It's kind of like another listener who asked, do the synthetics still work in futures options? Yes, it all still works. It's just for whatever reason, I don't know why it doesn't get a lot of love. Nick, do you agree with that? You think it's primarily the vol space is aggregated around equity, and a lot of that has gone on the S&P equity side, and we don't see as much in other complexes, and maybe that's why we don't talk about it a lot?
Well, first of all, I'll give a partial agreement to that. I know for a fact that if you go out and look at like the block trade browser, for instance, you can see that a lot of trades out there are covered. So you'll get delta neutral, outrights that will come with some futures associated with it. And we used to trade those packages in the Eurodollars quite a bit, and they trade quite a bit in the euros and the treasuries now. And part of the reason and to your point, there's no like systematic thing, I think, or products surrounded on that, but there are people who have written systems that are doing everything delta neutral, and what they'll do is they'll tweak the future price of the hedge in order to get a price that's inside. So if a market's 3.4, right, and the delta is 25 against a 6 future, an 06 future, they'll do a 25 delta against an 07 future because they think that they could trade out of those deltas and get a tick on 25. So you're cutting the price from 3.5 to 3.25, or whatever you're selling it at, from 3.5 to 3.75. So that does happen quite a bit, and a lot of times it's happening because people are trying to get an edge. They don't like the market, so they don't want to lift the offer or hit the bid. So they do it with futures because they think they can trade out of that hedge, or they even do it weighted one way, weighted more futures, or weighted a little bit less. So if they have to sell some or if they buy some, they don't get stuck so much on it. So I think it is out there. I know for sure it's happening quite a bit in the treasuries and in the stirs, because people are always trying to cut inside the market. And in fact, it's a big bone of contention because somebody will make a nice tight, 3.25, 3.5, and people are trying to trade inside that quarter tick market, when in the old days you just trade it and you give everybody an opportunity to make some money, whereas now they're trying to squeeze it to 3 3/8 at 3.5, which is just annoying as all hell. So anyway, I see it happen. Go look at the block trade browser. You're going to see plenty coverage. I don't know equity market. I don't know that well. So Mark's always has the better answer than I do for that, but I do see it in the futures options.
There it is. All right. Trying to get that music kicking off. All new systems here, Nick. Everything's brand new. So we're still working out all the kinks over there. But unfortunately, that music means we've come to the end of what a question palooza that was today. We still have more, so keep those coming, listeners. We love to hear. Obviously, you guys like yourselves some WTI. That's clearly I guess we're doing the right thing talking about WTI all the time because you guys clearly have it on the brains. But other than that, looking out here, of course, now there's, okay, here we go. Let's turn that music up a little bit. How's that for music level? Still listening, no music, people are telling me on the live chat.
I can't hear it,
really?
Greg.
All right, how's that?
There we go.
How's that? A little better? You know, I'm just trying again. We got so many new things going on here. All right, well, we won't worry about the music. I'm hearing it, so I'm rocking out to it. Too. I'm rocking out to it, even if no one else is. I don't want to turn it up too much. I don't want to wipe out Mr. Nick here in the process, but we'll play around with all those good levels here. Now really loud. Now I'm getting all these directions in my ear here, Mr. Nick. Too loud, not too loud. So everyone's a critic. Too loud, not loud enough. There we go. How's that, everybody? There we go. Let's just leave it there for now. I can hear it. Sounds lovely to me. That music, of course, unfortunately, means we've come to the end of an epic journey through the world of all things futures options. And how are we looking here? Let's see. Well, let's go to Mr. Nick. You touched on it earlier in the show, sir. What is cooking in the realm of all things quick strike? If they want to check out the futures slide and skew and all the other cool stuff, sir, where should they go? What should they do?
Well, first off, the shift and slide, that's going to be on all levels, okay? The free and in the subscription. You're not going to be able to click the free links to get more detail or to actually show the curves. But as I've been mentioning, and very shortly, by the end of the month at the latest, you'll be able to get a TWIFO-only subscription where you'll get the report, and all the links will be live and being updating, so you'll be able to see the intraday skew changes. You'll see a little short-term historical volatility. You'll be able to see the volume on the day and the daily tracking. You'll be able to see this week, last week, a week prior, and then month prior and the month before that. So it's going to be really nice, and I'm going to say the price out there because I want everybody to know it's going to be $300 for the entire year. So you'll get to track all day, all products on the CME. You'll get the this week in futures options with live links, so you get to see what's happening throughout the day and what's happening across the week. So we're looking to have that ready no later than the month. So, and we'll also be putting out there, because we get a lot of requests for lesser versions, because not everybody can manage the larger subscription. But the two of the most popular tools are TWIFO and then also the Spread Builder. Spread Builder will also become available as a separate. So we'll be doing a quick strike with little individual apps that you'll be able to purchase for a real low cost per year price. So stay tuned for that, and hopefully that's of interest to people.
We will stay tuned for that. Check it out for yourselves, listeners. Quickstrike.net or Bantix, BANTIX.com. I'm sure Nick will have some stuff to put out about that. We'll make sure we forward that your way as well. Because people have been listening. People have been asking. People clearly have a demand, have a need for the advanced tools. Look at all these questions we're getting. People want more. People have needs out there. If you have needs in the futures options market, that's the place to go to satiate those needs. And of course, while you're looking at all things in the futures options market, check out, of course, our friends over there, FTSE Russell, FTSE Russell.com is the place to go for a lot of their great data. Sean traveling throughout the hinterlands yet again this week. Hopefully he'll be back next week. Maybe bringing some delicious burgers. That won't matter for you guys listening, but it's sure fun for me, listeners, when he comes in. The studio smells like gourmet burgers for the rest of the day, which is always fun. Of course, give him a follow over there on Twitter while you're at it as well, at FTSE Russell, FTSE Russell. A lot of great data coming out. You guys asked us about the buy rights and about all the other things that they do in the data. That's the place to go to find it. FTSERussell.com or at FTSE Russell. And of course, you know where to go to find the papers and the podcasts from Blue and from Eric and everybody else. CMEGroup.com. That's the place for all that good stuff. Don't give Blue and Eric too much love. Don't want them getting big heads thinking they can do their own show all the time and not come on here. So let's keep them modest. Just a little bit of love. I would download every now and then. That's all we ask. All right, check them out. CMEGroup.com. They put their stuff actually front and center. It's kind of hard to miss Blues and Eric's reports now. So it's really prominently featured over there. I know you guys like it. CMEGroup.com. The place to go while you're there, /TWIFO. Place to check out the baby version of Quick Strike before you want to upgrade to the full version. And on behalf of Mr. Nick and Blue and Eric and all the rest of the team over there at CME, and Sean, who's traveling hither and yon from FTSE Russell, and indeed myself, I thank all of you out there for downloading, streaming, subscribing, asking questions, tweeting, and all of our polls, all that good stuff. Keep it coming. We'll see you back here tomorrow for Volatility Views, or if you can't make that one, we'll see you back here next week for more of This Week in Futures Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.